for disclosure, when I first joined Shell in Warri, Gideon practically held me through that period. So it's always a pleasure to have Gideon, and I know how busy his schedule is. I know how committed he is to everything that he does. So to always have him do stuff for me, do stuff for the society that he introduced me to. This is another part of the story. A lot of people see me as a volunteer, across all of this professional association, but it was actually Gideon that introduced me to this association. So a lot of things to unpack. But formally, I'd like to say thank you for every time, for all those years. It's if we take Shell as a starting point, it's almost it's over 17 years that I've known you. Wow, that's a long time. That's a lifetime. Like I'll definitely be an adult all over again, right? And I try to not process these things this way, like 17 years. And I'm sure a lot of people on the call are like, oh my God, how do you know yourself for 17 years? 17 years, an amazing boss. It taught me also when I did Shell Intensive Training Program. I don't know if you remember, Gideon. You came to class to teach us.
Okay.
And that was our first conversation. And a lot of water has been under the bridge after then. But I really hold you in high esteem. You know that. And if you don't know, now you do. I say it everywhere. Everybody knows that you're like my, my hand holder into all of these associations. So I say thank you. And this is also maybe to broaden the point around building network and also getting into the industry as a professional and being valuable to yourself and the association. You're going to meet different kind of people. You're going to meet bosses, peers, your contemporaries, your subordinates. How you make them feel and what you do to them would actually go a longer way than the nice fine faces and LOIs that we do. So it's my pleasure to introduce my boss to you. Gideon is in his third decade, that's 30 years, as a petroleum industry professional and business educator. He has contributed to developing more oil. Gideon was the finest sedimentologist we had in Shell, unlocking new frontiers, evaluating opportunities, and delivering new deals while designing and delivering business impacting learning events. While while we were both at Shell, it's interesting that we're both out of Shell now. While we were both at Shell, Gideon was, if you call geology, you will call Gideon's name after it. He was the one that held the geological lab of Shell together. And it was not Shell Nigeria, it was actually Shell Global in that regards. In 97, he entered with Chevron because he's an oil man. We call ourselves oil finders, explorers. He interned with Chevron before completing a Shell-sponsored postgraduate program. Thereafter, he joined Shell Nigeria in 2001, and then he proceeded to the headquarters in The Hague. And I also worked in The Hague, but I didn't meet Gideon. Gideon had worked there a long time before me. And then he worked in Shell London, working in the new ventures, exploration opportunity, identification, and deal delivery team. There is a saying among geoscientists that the best geoscientist is the one who has seen a lot of rocks. Gideon has seen a lot of rocks, both from a laboratory analysis and from a field perspective. In 2015, he left Shell to run his business, RockSolve. RockSolve is a thriving and pioneering business consultancy. It was the first business that made an attempt to bring technology into geology. He lectures part-time now, business and management at a UK university. Is a member of numerous professional bodies, an award-winning presenter, thought leader, an author, a keen golfer, and he enjoys traveling. I knew when he was starting out, when he started trying out the golf part, I knew. Because we talked about it, and it was back then in Warri. But it's a pleasure to have you here, Gideon. Thank you so much. We are looking forward to the class today. And I'm also fully immersed in it. really here to learn. Everyone is here to learn. Please, a round of applause for our faculty today. And yeah, the floor is yours. Please take it. Soak us with knowledge. Thank you very much.
Thank you, boss. And thank you to all of you for joining today. Thanks, Anne, as well, for organizing. I've got the slides, so I guess I have the power to share. Is that correct? Yeah, thanks for the introduction and everything. Just give me a bit while I try and get this sorted. Yeah, Bozui is amazing. I'm not surprised. She's always struck me as a very... Oh, by the way, she didn't mention it, but we are from the same alma mater. So we both graduated from University of Ilorin, geology department. So I think maybe that's where the affiliation started from. And since then, she's always been active in all these spaces. She's always been an excellent person. So I'm not surprised. She's still got a lot to give. And it's always a pleasure anytime she reaches out and we have a conversation. So thank you for inviting me to... as a faculty on this. I think this is amazing, as we were just having a chat, because for just a bit of a background, just to add to what she said, when I joined Shell in 2000, I remember having a conversation before I applied, and Shell was looking for management training, and I know I've told Bosun this story before, and I was saying to my colleagues that I'm a geologist, so what am I doing in business and management? I'm supposed to be looking at rocks. Well, anyway, I joined Shell and realized that everything you know is always applicable to business. Whether you're a doctor or a nurse or an engineer or a geologist, we all function within a business. Even politicians don't realize it, but the state should be run as a business, because essentially what all businesses do is raise funds and spend funds. Raise cash, spend cash. And that's what we're going to talk about today. Let me first apologize that it's impossible to cover everything about finance in 2 or 4 hours. Just to be clear, I think we're having another session next week. So my strategy is to cover as much today, and then we'll continue next week. It's a subject that if you want to explore it, of course, you could study up to a degree, master's, PhD in finance. So I will try my best to prepare you with the fundamentals. Let me mention at the start that finance, think of it as a language on its own. And what you want to learn is the lingo of finance. And because certain things mean certain things in finance, and you have to be specific when you call things stuff. So you can't get away with mislabeling items in finance. And so you need to understand that. But also this is about ventures and the fact that some of you guys have amazing ideas that you want to take forward. So I'll not just be making you a finance specialist, I'll be helping you to see how finance is actually one of the heartbeats of every venture, and why it's important for you, how to get it right, and why it's important for you to do it properly. I will start by kind of introducing you to the subject, and then we'll go from there. Now, just to be clear, feel free to stop me and ask questions at any time. I prefer that instead of just going on for the next 2 hours. So raise up your hand, you do a raising hand feature, or let me just ask, sorry, Bosun, Anne, is that the usual process? Or do you want me to go first and then we have the questions later, or would you want the questions as I go along?
Whichever way is fine. They can ask the questions while you're teaching, and then they can also put it in the comment section in case they do not want to talk about it.
Okay. Let me see, that's to be in chat, right?
Yeah, it doesn't have to be in chat. They can put it in the chat, and they can easily ask you, whichever one they decide to. If they put it in the chat, I will call your attention to it.
Oh, brilliant. Okay, that's good then. All right, so feel free to stop me, because the thing with finance is that they build on top of one another. So you don't want to miss any part of it, because once I've gone through one stage, the next stage I'll be using the language from the previous one. And if you then miss it up, then you'll be like, oh, what's he talking about? Because I've explained it 10 minutes ago. So bear with me on that. But also, just to say that because it's a language, finance is something you will always be learning. And as business people and venture leaders, feel free to, you have to be open to the language of finance. Your ideas might be excellent, and they are excellent, but if you don't get the finance part right, I'm sorry, as we all know, a lot of businesses don't survive. So welcome to the session this morning, and lovely to see you. Now, I don't know how you can see, if you can see the screen properly. Use a slide format. Let me see.
Yes, we can see the screen.
Okay, I don't know how clear it is. I'm just trying to play. I'm not used to using Teams. Okay, all right, that's fine then. Okay, so we go through this following content. I will introduce you to finance as a subject. We look at modeling, forecasting, and sensitivity analysis. And then we look at how to construct a financial model, cash flow and profit and loss. Don't worry, you understand that. At the end of the day, all the participants in the Ventures Lab program will be able to construct a realistic financial model based on sound assumptions, be able to carry out scenario planning and project your future revenue streams. You need this understanding and this language, the two things. You need the language, you need an understanding of how it works so that you can put together a robust package. As someone who has been there and has tried to raise capital, has gone to venture capitals, you have to speak the language. You have to demonstrate, no matter how great the idea is, you have to show that it can sustain itself post certain level of funding. And if you can't demonstrate that revenue stream, being able to that funding that you're trying to raise, being able to generate the revenue that will keep you going, then a lot of venture capitals might just back out because or the guys you are approaching for funding. Okay, good. So that's it. Let's start now. It's a big class, a big group, so we can't go around everyone. I've got the introduction from Bosun and Anne, so I kind of have an idea of the group. But I've been introduced as well, so it won't take too long in that regard. Before I start explaining everything, let's watch a short video, how to raise capital, introduces us to the subject, and then we'll build up from there, okay? So let's watch the video now. Let's hope this works properly. All right. Just to be clear, was the video playing? Hello?
No, not yet, sir.
No, not yet. No.
Okay, so I need to change what I'm showing then. Okay, yeah. All right, got it. Okay. What about now? Can you see a video?
Yes, sir.
Okay, good. All right. So let's watch the video then.
Can anyone hear the volume? Because I can't.
There is no sound.
There's no
sound. Okay, let me go back
There's
again.
no sound.
Okay. Sorry, I'm not used to this. I'm used to playing around in Zoom, so just have to bear with me a little bit. Include sound. I've seen it now. Yeah, good. All right, got it now. Okay, so it should work. Thank you anyway for challenging me getting me to use Teams. Okay. Let's try again now.
Raising Money for a Startup, presented by WallStreetSurvivor.com. Here's Richard. Richard came up with a brilliant idea. He can compress videos at a much higher rate than any other company on the market. But you can't just sell an idea. You have to build a business around it. Which means Richard needs to hire employees, rent an office space, and start marketing his idea. All of this takes money, and usually the more money you have, the faster you can grow the company. Now Richard has a few options. Richard can bootstrap his business, meaning he doesn't take on outside money, but rather reinvests the company's profits to grow the business. There are a few advantages and disadvantages to bootstrapping. By not taking on investors, Richard can keep complete control of his company and doesn't have to share any of the profits in the event that he can sell. By the same token, because the company doesn't have a lot of extra money, they'll have to grow a little slower by hiring less workers, be more frugal on acquiring new customers, and maybe staying in the garage a little longer. Richard can also borrow money from the bank. A bank charges interest on the borrowed money. Let's say the bank charges 5% a month in interest and Richard needs $1 million to build his business. Every month, Richard needs to pay back $50,000 until the loan is paid back. What's more common these days to start a business is to take on investors, which usually come in two forms: angel investors and venture capitalists. But both invest in your company by giving you capital in exchange for a portion of your equity. How much an investor takes in equity depends on the valuation of your business. For example, Richard needs that $1 million to move forward. He and his investors agree that the business is worth $4 million pre-money, meaning not including the invested cash. In that case, the investors would take 25% of the company pre-money or 20% of the company post-money. An angel usually invests earlier in the process than a VC, when the business is nothing more than an idea. An angel can often be a friend, or family member, or someone in the community looking to invest in a great idea. A VC typically invests a little later, when the business has some traction, meaning revenue or customers, and a solid business model. To learn more about raising money for a startup, check out courses at wallstreetsurvivor.com.
Okay. Sorry about that. Okay, welcome back. Okay. Presentations again. Okay. Okay, good. Okay, welcome back. First, to be clear, I guess you're all getting a share of the slides. Is that correct?
Yes, we can see the slide.
Yes, we are.
Good. All right. So you can watch the video on your own. It's a very good short video that introduces you to the concept of raising capital. The concept of finance as a subject is very simple. Finance deals with two things: money, raising money, and spending money. And it deals with the decisions you have to make as a business owner, as a venture, on how much money you need and what you're going to spend the money on. So finance is about choices. It's about the decisions that you make as a business on how much money we need, what we're going to spend the money on. Now, because the resources are finite, you don't have endless pot of money anywhere in the world. No one has an endless pot of money. Jeff Bezos doesn't have an endless pot of money. The Kingdom of Saudi Arabia doesn't have an endless pot of money. Everybody has to make a choice regarding where you're going to raise money from and what you're going to spend the money on. Dangote, everybody does, all businesses do this. And that's what venture capital is all about. It's about raising capital, raising funds, and then spending it. Now, with that understanding, the question you want to ask yourself at every stage of your business, the question of creating a model or a robust financial model, therefore, is about what decisions, what do you need money for right now, and why? These are the questions that you need to be able to ask yourself as a group. Okay, ask yourself, what do I need money for? What capital is required for the venture to go from here to here? So you have a staircase of where you need to get the capital, the venture to, where you don't need to go for money elsewhere. But to get there, each of those staircases, you need to raise funds a certain part of the journey. We call this element of entrepreneurship financing your financial journey plan. So you need to have a plan that says we need £10,000 to get to here, then we need £50,000 to get to here, or sorry, dollars, then $100,000 to get to the next stage. So that staircasing, that journey has to be clear. This is how much we need to get us here, how much we need to get us here, how much we need to get us here. Then once we get here, all of that is pre-revenue. Once you get to revenue, you don't sustain yourself, of course. Once you get to revenue, post-revenue, so you have a journey plan for pre-revenue, you have a journey plan for post-revenue. And we'll come to a lot more of that detail later. I just want to set the same first. So always think in your head, the communication is, or the decision-making process is, how much money do we need? What are we going to spend on to get us here? Next, when we get here, how much are we going to need to get us here? How much are we going to need to get us here? Once you get that sorted, you have your plan in place. And that's what we're going to go through for the rest of the process, okay? So that's the simplest form of explaining what finance is. Now, primarily for raising capital, the questions you need to answer to your potential future funders is why. A lot of people go to finance and ask how much. Oh, we need to raise 100,000. We need to, no. The question the people will be addressing is why. Why do you need to raise capital? What do you want to do with the capital you're raising? Number one, you've got an idea. Great. Has the idea been confirmed as something that can really work? What have you done to establish that our Facebook is going to work, or like I do with my company, that is going to work? Okay. Or what's the value to the market? So we are going to build this social venture, maybe solar panels for farmers in, I don't know, in Ogun State or Lagos or something. Great. What's the value to the market of that? Why should people have solar panel? Why should farmers have solar panel? Well, what's it going to do for them? Why should they have solar panels instead of, I don't know, anything else, coal or battery power, whatever? So you got to be able to define the value to the market that your idea is bringing. Then the next thing is the market still there? Now, a lot of ventures, a lot of ideas are great, but they were great for 1999, or they were great 10 years ago. Now with existing technologies, are you up to date enough in your space to understand that, wait a minute, the market has moved on? Now there might be a little aspect of the market remaining. When I drive home every day, where I live right now, I see a sign, someone advertising that if anyone has a VHS videotapes. Now, I know for most of you on this call, you're not familiar with things like VHS. But if you are someone of my generation, you know what is called VHS video cassettes. They're like rectangular things like that. They're like the size of a book. And then you slot them into a video playing machine, and then you press play. That's how we used to watch video, long before YouTube, long before the internet, long before Netflix, okay? So this guy is advertising and saying, if you got video cassettes, bring them, I will help you convert them to DVD. I smile again because those two markets and products are gone. I'm sure most of you on this call don't have DVD players. I don't have anyone now in my living room. But when the world moved on to VHS, we had DVD players. Now, you may remember CDs, but all the movies are on DVD. So you buy a DVD, you throw them in the player, and then it's playing. But this whole, also that has gone. Most people now stream their videos on YouTube or Netflix. Nobody has DVD players anymore. So anytime I drive past that advert in front of the business, I laugh. And this is a classic example of a great idea, someone that's converting video cassette to DVD, but that market doesn't exist at all. If it exists, it's going to be maybe one customer every month, because those two products are gone. They've been replaced. So your part of raising capital is to come up with a great idea, but then you have to explain to your financials whether the market exists. And then what do you want to do with money? What's your business plan? So on the one hand, you have a financial plan, but on this other hand, you also need to have a business plan that fits into that. So for example, what are you trying to do? Are you trying to first create a minimum viable product and test it? Or do you have a minimum viable product that has been tested and now you're going to take to the next level? Are you looking to buy materials to create the MVP? Or you've got everything ready, you want to go to market? Are you trying to hire expertise, maybe marketing, accounting, finance, wherever it is? Well, at this point, let me just briefly explain the difference between finance and marketing. Finance is about decision making. That's why the CFO is usually seated next to the CEO. The CEO of any company is the chief executive officer, but the CFO is the chief financial officer, and the two of them are 5 and 6. Because the chief executive officer, his primary job to deliver the business plan revolves around finance. It needs to decide how much money are we going to raise, either by selling products, by going to the financial market, whatever, how much money we're going to raise, and what are we going to spend it on. Therefore, he needs his finance director next to him. The accountant, on the other hand, is just the one that keeps the record. The accountant just keeps the record of what has gone. It's like a bank statement. So think of yourself as an individual. You make decisions every day. How am I going to raise money? Am I going to get some job? Am I going to start a business? Am I going to go to the bank of mommy and daddy, or the bank of uncle and aunties? Whatever. And then you say, what am I going to do with the money? I'm going to pay my bills. I'm going to go on holiday. I'm going to buy food, whatever it is. But then you have your banker who keeps the record of all your money. So when you go to get your bank statement, you say, oh, wait a minute, I've been spending too much on DSTV. I've been spending too much on traveling. So that's what accountancy is about. But finance is about the decision making, is about you saying, oh, I need to raise a 50,000. I need to spend it on this. So similarly with expertise, you as a venture lab, as somebody starting a venture, you need to be in charge of those decisions. You need to be your finance director. Now you get an accountant that helps you with the actual keeping the record, bookkeeping as we like to call it, ensuring that you are compliant with the law and keeping the records accurately, but you need to be the one making the calls, okay? And that's what you need to communicate. So we then go into how you can raise funds for your venture. So the first one is bootstrapping. And bootstrapping, option number one for raising capital, is essentially strapping your boots, which means funding your business with your own money. So that includes your money from your personal savings, your money from, if you have credit cards, or you can max out, but this is personal, your own money. So that's usually how most ventures start. The Apples of this world, Steve Jobs and Steve Wozniak, they got together, whatever they raised from their parents, they got some money from friends, you get all of that together, you try that. It's first option. You put into the venture, you realize you need more money. The next type of money that you then go for after spending your own money, and sometimes what we call in business world fools, and fools are FOOLS, your friends, your family, people who don't ask questions. We just say, you go to mommy and you cry, oh, mommy, I have this amazing idea, but I can't raise the capital. Do you have some savings? And your mommy go, oh, my lovely son and daughter, here is my $10,000 savings. You can use it for the business idea. We call them fools in finance, which is, apologies for that. They don't ask questions. So once you run out of that, you then need to go and look for serious other people's money. So OPM is your option number 2, which is other people's money. Now, other people's money, when you bring it into a business, you can bring it in one of 2 ways. Okay? You can bring other people's money into your business in one of 2 ways. It's very important to understand this, because when you go and ask people for money, you need to tell them, for social investment, a lot of the investors are not really looking for returns. They just want to make sure that you succeed, which is great for what you're doing. But just by chance, if you want to go beyond social investment and you want to go and seek non-social investments, then you need to understand this concept of our investments into small businesses or a business works. So essentially, any money that comes to the business can come in one of 2 forms. On the left of the slide is coming in as equity. And what do you mean by equity investment? Equity investment refers to, think of your business as a piece of cake or a big cake, a round cake, yeah? Let's assume that cake can be divided into 100 pieces or shares, okay? So you divide that cake into 100 shares. You have all the 100 shares, you have all the cake, okay? All the cake is there, you have everything. And then you realize you need more money. So you go to an investor, either angel investor, your friends, and you say, you know what, Gideon, I said, yes, I've got this amazing idea. I've tested it, or I'm in the process of testing it. This is the idea. You want to have a chat? And you said, oh, okay. Yeah, that's fine. Good idea. Good. So you said, well, I'm willing to part with shares in my business. So I've got 100, but I'm willing to give you 10 of them. That's 10% share in exchange for £10,000 investment. Okay. So what that means, therefore, is I give you capital for 10% of your business. Going forward, when that business becomes the next Facebook, I will own 10% of it. Conversely, if that business fails, my money is going down the drain. So when you buy shares in a business or invest as equity, your money doesn't come back to you. Your money is going into the business, but you own shares, typically a piece of paper that says, now, Gideon, you have 10% of Bozun's business, okay? And then I'll be calling her up every 3 months and say, please, what's happening to my investment? Have you made some money? Can I get some dividends from you? So equity investors only pay dividends, as you can see on the slide. Okay, so only dividends. On the other side, you can come to me and I will say, you know what? No, I don't want to get 10% or 10 shares from your business. Keep the 100%. I want to give you this money as a loan. And that's referred to as debt investment. Now, what that means is that the money is coming into the business as a loan, and then we sign a contract where you'll be paying me interest. So let's assume 5% or 10%. So if I give £10,000 loan and we agree 10% to make the math easy, every year I expect to get £1,000 from the business. However, if the business becomes Facebook, then I only get 1,000 every year. Versus if the business, if I make an equity investment. So they are not right or wrong, but you just need to be aware what your options are when you go and ask for capital. You need to be sure what you're offering. Some investors will tell you straight away they are not into equity investment, they just want to loan you money. Others will be like, yeah, we're looking for equity investment. These are the terms, okay? Any questions so far before I move on pretty fast? Just check the chat. No questions? Okay. Let's carry on. Now, this part is very important, and it's an honest conversation to be had, because we all like to, and I've been there, we all like to, if you start a venture or an idea, you think you've got the greatest idea in the world, you should be able to get funding for it. The reality is, not all businesses are fundable. And I know this is a bit, so I'll give you an example, just to tell the story. So, while I was still in Warri, there was a neighbor of mine who was doing this cooperative. He was loaning market women 20,000 naira. It was a decent investment for a business for him. These women come to his house, gives him 20,000 naira. He kept trying to get me to invest in it. Out of not trying to make money, just gave him some money, and he kept asking for more. And then I started telling him that, look, there's a concept in business called executive capacity, which means that all businesses are by nature limited in terms of the capacity of what they can handle. Now, a lot of people don't think like that. A lot of entrepreneurs don't think like that. I've had entrepreneurs or businesses come to me and people have all these grand ideas. And the first question I've asked is, do you realize that you don't have the capacity for so many reasons? Every business has a ceiling. Now, I know that's not what motivational speakers and all of that talk about, but it's the truth. It's the honest truth. Every business has a ceiling. Now, your ability to recognize that, then your ability to recognize what you can take on and what you can't, is what tells investors that you are in tune. If someone comes to me, and I've had this conversation before, because I'm part of the an angel investment network in the UK, and you listen to young entrepreneurs, and they don't want to accept that their business idea or their business as it is not fundable. First, a lot of them has to do with executive capacity. They don't have the business as it's constituted, does not have the capacity to grow to what they are trying to raise the funds for. So back to this story, this gentleman kept pushing me for money, and I said, no. I think you should just stick to what you have. Just stick to how much money you have right now. Keep giving these women, keep taking your percentage. That's the capacity, both from an intellectual point of view, but also from a market size point of view, from your business model. You shouldn't raise more money. Anyway, you won't listen. He goes to some other people, some of them I know, and raised a lot of money. Now, his business model for paying back his investors was based on these women or these other small businesses paying him back. But once people started giving me a lot of money, he started doing stupid things. He started giving money to people that he can't really trust. Long and short of it, everything went dead. Everything is dead. And I'm not surprised. And I could see it coming based on what we're discussing right now, that beyond a certain level, he shouldn't have been raising funds. He should just stop with what he's got and just if he stopped with there, he would still be in business today. But both his investors, and I know some of them, sadly, I don't care about my money. As I said at the time, it was more like a social thing for me as well. Just see what he's doing and just supporting him socially. So I'm not losing any sleep over the money. Not that I need it. Nice to have my money back. But the point is, not all businesses are funding. That's one. Secondly, some businesses, there are some people I like to call career entrepreneurs. So they go to the market and raise money. And everything they've raised is primarily about just saying I can raise capital. Being funded itself is not an indicator of success. And I've seen some very good entrepreneurs who have returned capital, write a note to their investors and say, guys, we can't go on. We've raised capital. We'll give you back what we've raised, what we have left from the money, but we've come to the conclusion that this is not viable. And that's very wise. And that's what a lot of businesses need to do. Now, the last point on this slide is the most important. And I would like a volunteer to help me read it out. So someone read out the last point on these ground rules.
Primary source of funding should be your customers.
Thank you, Tosin. I cannot stress this enough. I've got people come to me and trying to raise capital, and you could see from the business model that they will eternally be raising capital forever, because they have not designed a model where the customers will be funding the business going forward. So as you guys go out and talk to social investors, you need to demonstrate where the capital, how soon you'll be able to depend on funding from your customers. All the successful businesses of this world, the Shells of this world, the Dangotes, the Tescos, the Microsofts of this world, their funding primarily going forward comes from their customers. Of course, from time to time, they dip into the market to raise some funds, raise some equity funding or some debt funding, but your primary source of funding in your business plan should be from your customers, your sales. So you have to demonstrate that as you go out there to investors. There's a hand raised. Is that for question, just to be sure? Okay, Esther. Oh, is the hand's been pulled down? Okay, that's good. All right, yeah. So now that you understand this principle, let's move on to the next part of it, which is what then are the social investors looking for? Before we go into the details of building the model, you need to understand the concept of what typically investors are looking for. Now, social investors, as you've learned in the other sessions, may not ask you for profit or return on their investment, but you need to demonstrate that you're sustainable. So these 3 points will help you as you draw up your plans or create your model in approaching investors, okay? The first thing is the idea. Number one, is it doable at all, okay? It's good enough. People go on there are sort of conspiracy theories that go, oh, cars can run on water. It's just the oil companies that don't want the cars to run on water. And you hear sort of people see all sort of crazy things, right? Well, when it comes to business, crazy stuff doesn't wash it. So you can't come to social investors because these are serious people raising funds. You can't come to them and go, oh, we'll do this, we'll do that. Well, first, is your idea feasible? Is this something that can be executed? But we're going to equip all the farmers in Nigeria with mobile phones in 1 year. And the question I'm asking is, how do you intend to reach all the farmers in Nigeria? How many are they? Have you thought of how many people you need? How much capital? So it's not enough to have a grand idea. Your grand idea has to be rooted in reality. So the first thing about your idea is that they should be feasible. It should be something that is executable. That's what I like to use for it. There's something you can execute. That's one. Then the second thing is, when you are going to deep pocket social investors, like some of the guys you guys will be talking to, some of them are interested in the scale. So if you can solve a problem for 10 people, great. But do you understand what it takes to solve the same problem for 1 million people? Can you see how to scale from 10 to 100 to 1,000 to 100,000 to 1 million? What changes when you go from servicing 10 people to servicing 1 million? If you've got a little server, a little internet setup, web setup, do you understand what it takes to go from handling 10 transactions to 1 million transactions a day? And stuff like that is what will let them know, okay, we'll give this guy some money, or this guy doesn't know what he's talking about. Then is it a fresh look at problems, or are you just rehashing old ideas here? It's very good, especially when you're seeking investment, to be able to demonstrate the uniqueness, the freshness of your idea. And lastly, as I explained earlier, the market. Does an opportunity exist in the market? Or has the market gone by? Or the market is 10 years down the line? I remember when I went to the market and tried and raise some capital in the blockchain world, I returned the investment back because after talking to the IT people behind what I was trying to do, the market was not ready. So maybe we're ready in the next 5 years, but at the time, it's not. The technology is not there. There were some ideas the IT guys were throwing at me, but I said, no, I cannot hold on to people's capital. This is not ready. We should have this conversation in 10 years' time. So that's where you have to tell yourself, I have this amazing idea, but is this something we could do now, or is that going to be 5 years down the line? Or if I get 10,000 or 20,000 or 100,000 pounds now or dollars, can I go out there and execute? Or is it a case of you're having some problems? You should have defined those problems or those challenges at the ideal stage. So once you get the idea sorted, you then go to the business part of it, which comprises of first the team. I know you guys are this venture cohort are in teams. Boston, is that correct?
Yes, some of
No.
them are in teams. Okay, man, go ahead.
Oh, sorry. I don't know what you mean by teams, but when you say group, so they are like maybe group of 4 persons who built an idea, 1 person in that order.
Okay, so you have some that are just 1 person and some are like 4 people.
Yes.
Okay.
Sorry, Anne. Yeah, you're correct.
Yeah, that's fine. Okay. So just to be clear, even if you're a team of 1, you need to have an understanding of the concept of teams. Now, if you go to any investor and you say, oh, I'm the only one that will do everything, that's a red flag. That's a no-no. So you need to understand that, look, one of the reasons I'm raising money is I recognize that I need someone from maybe coding, web design, maybe manufacturing, maybe electrical engineer background, maybe someone in project management. This concept of the fact that you will need a team to execute your idea is very important. Nobody's asking you that you have the team now, but part of your responsibility as someone who is starting a new business is to recognize who you need and when. Now, there are many platforms today where you could hire someone for a day. Maybe you need an electrical engineer for a day. You need a marketing person for 5 days a month. You need an accountant for 2 days a month. But that concept that this is the team that is required to execute this idea is very important in your investment criteria. So social investors will be looking at your team. Then you look at your business model. And this is a very central part, and I can't cover it in like I said, in the time, but you have to understand what you're trying to bring to the market and how you're trying to do it. So your model has to be clear. We want to equip people with power through solar panels that they will pay for gradually. Yeah, we get that. So how are you going to make money from that? What's your revenue model? Are you going to make money by selling subscriptions? Are you going to make money by buying products from them? What are you going to do? How are you going to do it? There's so many models out there, but you need to be very, very clear. And then lastly, your pricing and cost structure. How are you going to incur your cost? Are you going to hire 10 people? Or are you going to be freelancing people until you can hire them as full-time staff? How are you going to price? Are you going to price once a month, once a year? What's the pricing structure? And then that's for today. That's for the money you are raising now. Then you need to have a plan for the future. You need to say, I want to become a Dangote. Great. What's the plan? How are you going to become a Dangote or a Bill Gates? I want to build $1 billion company. Great. People have done it, but how are you going to do it? How is your team going to take this idea from servicing 10 people to servicing 1 million and making $1 billion a year? So you need to have that strategy, and then you need to say, this is how the funds, we need 10,000 now. I've explained that before, the usage of the funds. This is the value we are bringing. And for typically venture capitals and profit-oriented investors, you need to give them a strategy. You need to be able to say, when we've raised £1 million or $1 million, we've turned this idea into $100 million generator every year. You can sell your shares. We'll go and exit either by selling this to Shell, or we sell this business to Microsoft, and you can walk away with your 100,000 now worth 10 million, something like that. Okay? So all this, if you are making slides that you want to present, this is a very good set of slides that you can use. If you just cover each of those points here correctly, you are 100% towards creating a robust financial model. The actual numbers, cash flow, which we'll talk about later, it has to be underpinned by this slide here. So if you cannot link those numbers to this grand plan, then that's where investors will start picking holes in your ideas. That's where some of them will go, we don't trust what Angela is trying to do, or what Janice is trying to do, or what Ebenezer is trying to do. This is not likely to work, okay? So this is where you need to do the homework. And I understand I'm available, or I'm spending time with some of you who might be interested in me spending time with your specific ideas. I'm happy to do that, but these are the kind of conversations we'll be having. So if you haven't done your homework in this regard, this is the time to go back to the drawing board and make sure all of these ends are tied together. Okay. Once again, any questions so far? Okay. So we're going to watch another video now. Start off with the next.
Okay. If you allow me, I just wanted to say that we have a lot of representation across the regions. We have Hungary, India, help me here, Nigeria, we have from the US, Canada, we have all of this continent. So in terms of examples, it'll be nice to also share some of those examples. I just wanted to call your attention to that.
Thank you for that. I appreciate that. I saw a lot of Nigerians name at the top, so I thought it was mostly Nigerians. Thanks for that. That's very good. All right. Well done, everyone. Okay, so let's watch another video now. Startup funding explained, to build on everything I've said so far. Okay. I need to change it again. Just give me a minute. Okay.
Okay, sir. So we can't hear. I want to be sure there is no volume. Yeah.
Okay, sorry about that. I need to go back again and to exit. Okay. Yeah.
It all starts with the vision, the project, the product.
Is it better now?
No one has done it before. Unbelievable. It's so painfully obvious. Can you pull it off? Maybe. You're two friends. You are excited. Design a logo, design a name. All fun and games. Design a concept. Things get serious. You decide to make this a company. You need a structure. A legal structure. How much will that cost you? In the US, incorporating a company will set you back anything between $25 and a few $1,000s. That's in part registration fees, which largely vary depending on where you are, and legal fees, which vary depending on how fancy you need your first shareholders agreement to be. Your incorporation turns out to be on the pricey side. Also, you need to rent a server in order to develop your product. Therefore, you decide to collect some other people's money for it. This early in your venture, who on earth would give you their money? You will get it from family, friends, or by crowdsourcing it. Usually, a newly incorporated company issues 100,000 shares, which are equal pieces of ownership. You need to decide who will get how many of those. You agree on 40,000 shares, or 40% of the company, for each founder, and 20,000 shares, or 20% of the company for a well-off family friend who buys them for $50,000. It's called an investment, and at such an early stage in your startup, it's called a seed investment. The money he pays now belongs to the company. If the company fails in the near future, which statistically speaking is the most likely scenario, you will probably never see a dime of it again. $50,000 for 20% of the company puts the value of your enterprise at $250,000, which puts the value of your 40% at $100,000. Not bad. Please sign here, here, and here. Congratulations, you incorporated your company and finished your seed round of investment. A year has passed. You're having a successful beta trial with customers. Time to hire a few more people. Rent not just a server but a small office space. The $50,000 of seed capital only got you so far. Time to collect your first big round of cash. You will do this in a so-called Series A round. You're looking for an investment of $1 million. This time, you're contacting angel investors and venture capitalists, also called VCs. VCs are people who work for venture capital firms, which raise venture capital funds. They take other people's money, which they then invest into young, risky companies, such as yours. Angel investors are individuals who professionally invest their own money into young companies. Often, they successfully sold their own startup many years ago and are now looking to support early ventures. You contacted a few VCs and angels. Some of them you found online, some you got in touch with via friends and colleagues. You sent them mails. You sent them a business plan. Usually, they don't care much for the business plan. They want to see the team. Is it competent? The idea. Is it special? They know it's not easy. What have you already achieved? Is it promising? What could you achieve? Can you dream big? You set up some Skype calls, a bit of small talk, a lot of business talk. Describe the vision, easy, you've done it countless times by now. They ask you tough questions. Have you heard of that other startup which does a similar thing? How are you different? You spark interest. You have second calls, you have third calls. You meet them in person. They might invest. Time to talk valuation. There is pre-money valuation and post-money valuation. The pre-money valuation of your startup is how you currently value it. The post-money valuation is the pre-money valuation plus the investment you're looking to collect. This is usually the one that you reference when you negotiate, because the investment divided by the post-money valuation equals to the investor's share in your startup. Investors want a low post-money valuation to get more for their money. You want a high post-money valuation to keep a larger share. You suggest a post-money valuation of $8 million. For the investor who would put in $1 million, this would mean a 12.5% stake in your company. A few weeks down the road, there are two offers on the table.
Where worlds collide, it means that two things are coming together. So when you think of technology or data, you think of, I don't know, profit or growth or society.
One VC offers an investment of $1 million for a post-money valuation of $6 million. An angel investor you talk to offers to invest $500,000 for a $5 million post-money valuation. The offer of the venture capitalist sounds like the better deal, but the angel has great connections in the industry. It's called smart money. What do? You decide to go for both. You tell the angel that you have a standing offer of $6 million post-money valuation, but you would really love to have her on board. She agrees to invest at a $6 million post-money valuation. Great. How's the cake split this time? Let's do the math. Together, the VC and the angel will put in a total of $1.5 million into your business for a $6 million post-money valuation. This means that they will own 25% of the company. You, your co-founder, and your family friend used to own 100% together. With the new investors coming on board, you will be diluted. After the Series A investment, your cumulative share will only add up to 75% of the company. This dilution happens proportionally. Does this mean that you have fewer shares now? No. Here's how it works. Just like your company issued the first 100,000 shares when you incorporated it, it will now issue more shares for the new investors to buy. A company can create shares just like a central bank can print money. The total number of shares of the company just changes, while your number of shares remains the same. How many shares does the company issue? If 100,000 shares are now only 75% of the company, it means that 100% of the company will now be equivalent to 133,000 shares. Therefore, the investors receive 33,000 newly issued shares for their investment. Since they pay $1.5 million for their shares, each share is now valued at $45. Your 40,000 shares are now worth over $1.8 million. Congrats! This whole process of a company issuing new shares to receive cash is called a capital raise. If things go well, the Series A won't be the last capital raise of your startup. There will be a Series B, a Series C, a Series D, and so on. For each investment round, the company valuation will hopefully increase. Also, each time your company takes in new cash from investors, you will be further diluted. Remember how I said that your number of shares remains the same though? I lied. Actually, there will usually be stock splits along the way, which convert each single share anyone holds into multiple shares. Hence, your number of shares is doubled or tripled every now and then, along with everyone else's. The purpose of this and many other things that are determined in the term sheet are a story for next time. You don't care much for legal work anyway. Your primary interest is in growing your business, which is now on track to reach new heights. It has been 6 years since you founded your company. You have successfully completed 4 investment rounds since then. You launched your product by now. Guess what? Customers love it. You're a huge success. The big blogs write about you and whatnot. Most importantly, last quarter, your company has not been losing money for the first time. The business made a profit. Time for the exit. Exiting the company is investors' talk for selling their shares. Everyone who invested cash into your business since the beginning has been quietly dreaming about a big profit. The earlier they invested, the bigger of a risk they took, and accordingly, the bigger of a profit they will get if the company really takes off. There are usually 2 ways of exiting a company: selling to one of the big guys or offering it on the stock market. If you sell out to a big company, the investors will usually sell all their shares at once. You and your coworkers, on the other hand, usually won't. Whoever buys you needs you people to stay motivated to run the whole thing. Therefore, your shares will be transformed into shares of the company who bought you and then made available to you over time. This is called vesting your shares. If you leave early or you don't reach some milestones you agreed on, then you won't receive all your shares. The much cooler way to exit is to become big enough so that you will be able to sell your company's shares on the stock market. The process of doing this is called an initial public offering, or in short, IPO.
What's an IPO? What's an IPO? I still don't know what an IPO is.
Don't believe Martin Scorsese. How it works is painfully easy. In essence, an IPO is just another capital raise. Once again, your company will issue new shares, only that the investor who buys them this time is neither an angel nor VC. It's the public. The day you go public, your company dumps a bunch of new shares on the stock market. From then on, people can buy and sell them among themselves. Furthermore, you now hold tradable paper, almost as good as cash, the price of which goes up and down every day. You can sell your stock into the stock market at market price anytime, with the exception of IPO lockup periods, which are a topic for another time. You floated the shares at a starting price of $64 and they shot up to over $70 on the first day of trading. Due to stock splits you did along the way, you are now sitting on 10 million shares of your company. Your personal wealth is over $700 million. You could cash in, but do you want that? It feels like yesterday that you two just had a vision. Now, you're 1 in a million. There's a lot you achieved and yet endless things to do. Even though investors call it an exit, for many founders it's just the beginning.
Welcome back, everyone. Okay, welcome back, everyone. Sorry about that. Okay. Yep. Let me share my slides again. So, any questions so far?
I actually think we need to get interactions from the class. It's about an hour or say 45, 50 minutes that we've been listening and learning. So let's get interactions before we go to the next parts. What have you learned? If you don't have questions, that means you've learned a lot. So please tell us what you've learned. Tosin has his hands raised, but I'm also keen. Tosin, you get your chance, but I want to have interactions on the charts. If you don't want to speak, what have you learned? Great. So now they're waking up. All the hands are up. So yeah, we'll take Tosin, then we'll take Andrea, and would take it in that order. But in the meantime, please share what you have learned on the chat.
Hey, hello, can you hear me? Hello.
Yes, I can hear you. Yeah.
Okay, perfect. Well, for
Andrea, please hold on a bit. Tosin hand raised first, so let him go first.
Okay,
and then
yeah,
we'll
don't
come to
worry.
you. Yes.
It's okay, thank you.
All righty. Tosin.
All right. All right. Thank you, ma. And thank you for that great presentation, sir. When you were talking about the few good rules, you mentioned executive capacity and business ceiling. So that those two things must be well defined. So if one will be able to, if one will seek more investment for the business, and that is in line with the rule that you stated that your primary source of funding should be the customer. So until you have, I'm trying to reiterate this to be sure that I got what you said before raising my questions. You said for you to, before you seek more funding, you must define your executive capacity and your business ceiling. So my question is that if it takes a particular venture, a particular business 2 to 3 years before being able to increase its executive capacity and business ceiling, will such venture, such business still be able to get investor committed to the business? Because I saw I've seen different investors stating that if the startup is more than 3 years, if it is more than 6 or so number of years, they were not ready to invest into the IPI again. So I want to clarify, how do we reconcile that between the increasing the executive capacity and business ceiling, the time it might take, and also being able to still get investors to commit to the idea? That's my question, sir.
That's a very good question, Tosin. I will come to that, but if you take Angela's question as well and comment, then I might marry the two together. So let's see what Angela has to say. But thanks, very good question, and good roundup of what you've learned so far. Angela, you can go now.
Well, it's Andrea, but it's okay, I understand.
Sorry, Andrea, so sorry.
Don't worry. Yes, I have one question about the main role of the IPO person. What happened if at the beginning of the investment we don't found that person? I mean, how they get in the investment plan?
Thank you, Andrea. Just to clarify, when you say the IPO person, what do you mean? Is it the person raising the capital, or is it the investors or the business raising the capital?
The second one.
The business raising the capital.
Exactly.
Brilliant. Okay. All right. I think the two are very similar to what Tosin raised. So if I could just take those two. At first, not all investment are good investments. So to answer your question, Tosin, there are as in all businesses, as in all investment scenario, there are those who want quick returns. Now, if your business has the capacity, as you've learned today, to generate such a quick return, then you can have that conversation with that investor. However, if you're a Facebook or a tech company that you're not going to generate your first revenue until like 2029 or 2030, then that's not investor for you. In fact, if you notice in the video mentioned the concept of smart money. So not all money is the same. Who is this individual that is bringing the money? I remember once I listened to a pitch from a restaurant chain, a set of young, smart entrepreneurs who set up this chain of restaurants across the UK, and they came to the market to raise some capital. I was so excited when we had the conversation. I couldn't wait to invest in them personally. But then they came back and said, thank you, Gideon. However, we've received investment from someone that's got restaurant experience. So we kind of value that a little bit over just capital, because I didn't have restaurant experience. I've always worked in energy, oil and gas, and now in education. So, and he said, and he turned down the investment. So, Tosin, the question to you is, the way you want to vary it, if your business, you've done your model, you've done your analysis, you've done a good job, just put it all out there. If this individual is not ready to wait for 3 years for you to start generating returns for them, and they can't wait, then don't take the money. Not all monies should be taken. That's the answer for Tosin. For Andrea, the IPO process is not as straightforward. There are a lot of checks and balances. Okay, typically how it really works in real life is that the company raising the capital actually raises the capital from investment banks. So the Goldman Sachs, the JP Morgans of this world, the Chase, and those ones actually fund that company and then go to the market and get the money. So, and what these guys do is typically before they give you that money, they get on board on the board of directors of this company. So they are in it. So they are not usually as external as it looks. So then they then fund you and go out there and complete the process, get their money out, and then the rest can come to you. And with them on board, because now they also have their hands in it. Typically, so it's not a case of take some money and disappear off the face of the planet. Of course, there are frauds being perpetuated in all industries, and this space is also filled with fraud. The press is not short on stories of fraud taking place. So yeah, but of course the investors need to watch out. But by the time you get to IPO level, you are pretty grounded, and there's a lot of checks and balances. So if I could check with you, Tosin and Andrea, are your questions answered, or do you want some more clarification?
Well, for me, it's fine. Thank you for the answer.
Thank you, sir. You've answered my question, sir.
Okay. Bosun, do you want to take some more, or do you want us to fire on? Bosun, I don't think he's okay. All right, I'll just carry on now. Okay, yeah.
Yeah, sorry, it took me time to do this.
Yeah.
Apologies.
Yeah, I was saying, should I carry on now after taking those two?
Yeah, I think it's a good place to continue. We also have a few comments in the chats. I don't know if you saw them, but there was one from Bami or Ebenezer. So yeah, and Victor. So yeah, we're in a good space. I'll just like to crave your indulgence. Let's run this for the next 30 minutes, and then we'll continue the other one in the next class, in case you still need longer time.
Yeah, I'll surely will. Yeah, thanks. Okay, that's nice. Good to see the comments here. Well done. All right. So yeah, so you might be wondering, oh, why is he going on and on and on about this? Well, yeah, this is really what the process of creating a robust financial model is about. It's about all the things we've learned so far, understanding the name of the game. Of course, you guys primarily are going for social investment, which is slightly different from for-profit investment, but you need to get the same thinking cap on. You need to think like you're going for venture capital investment or something like that. So because even when you're presenting to social investors, they will want you to demonstrate the same acumen that they'll be looking for if they were trying to get profit. Because remember, your social investors want you to deliver. So they want to see that you understand the name of the game. And if you don't, then they might not want to fund your idea. So to carry on, I've got a little chart. It's a little busy, but it's just a summary of everything we've learned so far. And it just kind of explains that when you start up with an idea stage, you own 100% of the business. Then you get a co-founder in, you share it 50-50, but it's typically 100% of nothing. You have an idea, it's just 100% of nothing. You get a co-founder in, you and the co-founder develop the idea, you split it 50-50, and then you go to your friends and family. Your friends and family give you some money, maybe for a certain percentage. And then you go from friends and family, you spend all that money, you go to now seed rounds, First, you start with your angel investors who come in with maybe $100,000, $500,000. They get in. Two of them get in the yellow and the purple, and then you get an office. You hire some staff. You blow through all of that money. Typically 12 months. You need more money. You go to a series of seeds: seed A, seed B, C, D. I get some venture capitals in. You get some early employees in. You start dividing the pie. You can see the same pie being shared up. And then now you own 17% of the company, but 17% of a big company. And you have other investors saying, and then it gets to a point where you need to raise a lot more money. And then here you get the bank saying, and you go for an IPO and you raise billions. And then you go global and achieve your goal. So this is typically how it works. This is a very nice chart that tells the story of the funding journey, as we like to call it. For those of you who will be successful with the social investors that AAPG will be introducing you to, congratulations in advance. But for those who may not be able to raise funds through this, well, there are other alternatives for you to raise funds, and I will just run through a couple of them. Here is one, Kickstarter. Kickstarter is it's a very good, typically focus on the arts, film, music, games, design, and all of that. But you can go to Kickstarter, create your idea, create your video, market your idea, and go there and try and raise some capital. Maybe you're writing a book or you're producing a movie. You can easily go there, tell them how much you're trying to raise. The same principle as I've explained. Demonstrate that you understand the game or the name of the language of finance. Present your idea on Kickstarter and get people on Kickstarter to fund it. In exchange, for example, let's say it's a movie, you can give them tickets to the screening, you can offer them all sort of stuff. And depending on what you're trying to do, as I said, it's mostly artistic, but yeah, you can use that to bring your creative idea to life. If it's a book, you can, for a certain level of investment, you can sell them 50 copies of the book or something, donate to some schools where they live or something. Just a couple of ideas of how you could raise funds, telling them what you want to do with the money, a bit social as well, because most of the time it's not really people looking for profit. It's just people who want to support a creative project, and you can always go there for some funding. This is typically for UK entrepreneurs. This is the one I was saying I'm a member of, and yes, it's all sort of people with ideas there. You can go on there as well, create your package, tell your story, and like-minded investors will then come in and either invest in your business. Typically, how it works is that if you create an account there right now, if I create an account as an investor, I will see all the projects that matches my space. For example, I like space in education. I like things in energy, and sometimes a bit of food as well. So you go in there, what you like, and then you see people trying to raise funds. It might be good for some of you to go in there just to see how other entrepreneurs are packaging the opportunity such that to attract capital. And people have been able to successfully raise funds on the Angel Investment Network. So that's another one for you. There are incubators and accelerators. This what we're doing today is what Ventures Lab is doing with Pro Ali is amazing because it's a form of incubator/accelerator for your idea. And I think it's an amazing idea from AAPG. So well done to Bosun and the team and everyone on that, which essentially means you're not just getting capital, but you're getting support like this session now, such that you kind of progress your idea beyond what you've been doing on your own and getting the necessary support to help you take it to the next level. So there are a couple of incubators and accelerators. Sorry that it's a bit UK focused. I've used this in the UK a lot, so that's why I've got a lot of UK focus. Plus, I don't really know a lot from other countries as well because I'm not really played in the finance space in other countries. But if you're in the UK or want to play in the UK, these are examples of UK accelerators. But if you look for accelerators in India, in the States, there are lots of them as well. In Nigeria, I'm sure there are a few accelerators as well. Anywhere you are in the globe, you can search for incubators and accelerators in your area. And AAPG is one, okay? If in the UK, there's a government funding options, the same thing as well for social investment. In fact, I will say that a lot of government funding options exist globally, where if your idea is good enough, you have the team behind you, you can explain your model, you are also likely, you may be able to attract government funding. They're not easy, but at least you've learned enough today to kind of get you thinking in putting your ideas together better, okay? Good. So now what I want to do at this stage is, without sharing anything confidential or intellectual property, could I have a few volunteers tell us, what do you want the money for? You don't have to tell us how much. If you want to, that's fine. But just give me an idea. Give us an idea based on what you've learned so far. What really are you looking for funding for? What are you trying to do with the funding you're trying to raise? If you want to mention how much, yeah, go ahead. So over to you. I will hand over to Bosun to also maybe mediate that as well. So just tell me, give us a discussion. What are you looking for? Why are you looking for money?
So for the Venture Lab, I know that we have Tosin here. We also have MD Ahan and a few others, and also Andre. So yes, please go ahead and share your thoughts. Why do you want funding? Why did you submit your idea for the AAPG consideration in the first instance? Tosin, if you are speaking, we can't hear you. I saw it moving. I'm not sure if you were speaking or trying to.
Sorry about that. I didn't know that my mic was unmuted. However, there are two major things for which I submitted my idea for AAPG investment. Number one is that I need money because I need to raise a team so that I can work towards achieving my idea. So the people that will contribute to the idea, I will definitely need money to give them as a motivation and for them to deliver their service in contributing to the idea. And the second reason why I am putting for the investment is because while I put in for the funding is because I need money to also get the finance to get materials that I will use to achieve the project. So the materials including software, I need data acquisition to acquire the data needed to achieve the idea, and some gadgets.
Thank you for that. I like that. So just to be clear, when you say you want the funding for people, it's a very big one. So is it because you cannot do what they are doing, or you need extra hands? Does that make sense?
Yes, I get your question, sir. I can do some of these things, but if I want to do it all by myself, I will not be able to meet up with the timeline for the achievement of the idea.
Okay.
And then in addition, there might not be much more creativity into the betting and to the achievement of the idea as expected when it's just one person's it's just a person's brain that is put into the work. So they can bring their own special ideas, innovation that is different completely from my line of thinking, but contributing and not totally against the idea.
Okay. Thanks for that. So just while you are still here, Tosin, so are these people needed to take you to MVP? Is the project a one-off? So once you've done it, that's it? Or is it something that you need to keep going on after you've done it?
Something that needs to keep going on. So it's something that is done once and for all.
Okay, something that is done once and for all. That's it.
But yes. Okay. But it's only be able to generate returns in the long run and not in short term.
Okay.
It is short.
Okay. Yeah, I understand now. Thanks for that. Yeah, someone else want to go? Yeah, thank you, Tosin, for sharing. Yeah, next.
Yeah, so we have Andre. Andre, go ahead.
Hello. Well, yes, we are here. Well, the student chapter, we are here because, well, we are from Venezuela and we have one problem that is, I feel that your science on general, we don't know how to sell our idea on general. So something we need to understand, and that is the reason we are here, is that we are fundamental part of the technical aspect in a project. And sometimes I feel we have this gap. And the reason we are here is because, of course, we want to learn it and start to understand that we need to sell our ideas, the technical part, and for found people in this area or investment that the people want to come here and funding our project, because that is the main issue we have here. But of course, first of all, we need to learn about it for sell our ideas.
Okay. Thank you. Thank you, Andrea. I'm sure you're learning a lot so far today on how to put your ideas out there and get the support that you need and to sell it more. Well done. Thank you. Anyone
Thank you
else?
for the class.
Yeah. Anyone else who wants to share why they need funding?
Or maybe they don't need funding.
Okay.
Maybe
good.
after hearing you, they're like, my business is not fundable.
Okay, all right. Now,
Right.
don't be scared. Don't be scared. But it's a good process to go through and understand how it works. Because now we're going to go to what I call the finance fundamentals. Okay, what I call this is what some of you this is where you thought I was going to start from, but I start from where I've been because this is what most people think finance is about. What I'm going to go through now, where I'll be talking about income statements and all of that, balance sheet. Yes, that's what some part of finance is about. Or it is everything else that have come before now that you need to understand. Okay, if you don't understand that, the rest of what I'm saying today, what I'll be going through today and next week, will be a waste of time, essentially. So if your business is not fundable, if you don't get the concept of executive capacity, and all of that market, then there's no point doing the rest of what we're doing now. But hopefully what you've learned so far has got you thinking about your financial journey or your financial plan. Or why does your business need money? What do you want to do with it? And how are you going to return it? What type of funding are you looking for? What kind of money are you looking for? Debt, equity, and all of that. So now that you get all that idea in your head, we can now explore the fundamentals of finance, okay? And hopefully it's all start coming together. Good. All right. So the first fundamental of finance is that finance is about management. And this is very important. It's about management of money. So you have to think about it that way. You are a manager of money. Some people manage people. You know, like you go to work, you have your manager, you have a boss. But when it comes to finance, you are managing money. So some people think finance is about, well, just money. No, it's about managing it. And when we say managing money, what do we mean? Well, as I've explained earlier, starting today, that finance and accounting are not the same. Accounting is like on the right, is about collecting, analyzing, and communicating data. So they are the guys that look after the numbers. They're the guys that say, oh, Mr. CEO, Mr. Jeff Bezos, we need another these are the numbers. We've spent 2 billion on hiring staff, 1 billion on these, blah, blah, blah. They give him the numbers. But finance is about the decision. And there are only two decisions you need to make in finance. Only two. First one, how are we going to raise money? Where's the money going to come from? How much? So first decision is about raising. The next decision is about what are we going to do with the money? So we're raising money and spending money. The decisions of Raising money. How much? Where are we going to raise it from? What type of money are we looking for? Equity, debt? That's the first part. The second part, what are we going to do with the money? For what? Why do we need this money? That's why the question I asked earlier, why do you need funding? Why are you going to these social investors and asking for money anyway? What goals are you trying to achieve? So that's the big difference between finance and accounting. One is about decision making, the other is about collecting and analyzing data. They support one another, or should I say, the accountants support the finance function because they help them gather the data. You can think of it as a geologist. You go to the field, you gather the data, you send the crew out to the ship to gather the seismic data, but the geologist sits down and interprets it and decide where we're going to drill. So that's the same thing with finance. Accounting, analyze, collect the data. You as a finance person, as the owner of the business, you need to make the decisions. Now, here's the question then that I want to ask. Which of these, finance or accounting, which one do you think is more important to a business and why? Raise up your hand and share your comments. Which do you think is most important and why? Finance or accounting? Any volunteers? Oh, we've got two. Excellent. Okay, Victor, let's go with you second. Then we've got Courage.
Okay, good evening, sir. Thank you very much for the wonderful section. It's been wonderful and I've been learning a lot. Okay, for me, I would say accounting, right? Since accounting from based on what you just said is collecting and analyzing. So before we make decisions, first of all, we need to understand our decisions are supposed to be made based on facts. So we are expected to collect and analyze from data, just like it stated, the geologist going to the field, trying to understand one or two and get into the lab to put things together and finally allow for decision making. Thank you.
Very good answer, Victor. Thank you. Yes, Courage, please.
Okay, sir. I stand. Good afternoon, sir. Thank you for the wonderful session. I stand with Victor. Exactly like I agree with everything he said. That is what I wanted to say. I think it's better to, accounting is better than the finance, because if you don't plan properly based on what you've been taught, you tend to lose the finance you've got and you end up closing your business. Thank you, sir.
You're welcome, Courage. Thank you very much. Does anyone dare to disagree? Is anyone bold enough to disagree with them? But thank you, Courage and Victor. Okay. Anyone bold enough to disagree with them?
I think Precious disagrees. By the chart, you mentioned that I think finance is more important because from their definitions, the management of money would influence and further define the state of records that will be kept, that will be accounting. So he's going for finance.
That's very good. Well done. Okay. All right. Good. So now we're going to put it to vote. Thank you, Precious. So everyone has to vote. Now, if you click on React, now here is first one. If you think accounting is more important, click thumbs up so we see how many supports agree with Courage and Victor. Angela says both are equally important. Okay. Can we see, is it possible for me to see the reaction, the number of people voting? I just want to see, just to engage the class a little bit. Angela, I think both are equally important. You need to have a balance for both for a project to be successful. Yeah, well done, Angela. Thank you. Okay, let's raise hands. Okay, so if you think that accounting is more important, if you agree with Courage and Victor, raise up your hand. Click the raise hand button. Let's see the numbers. Okay, keep going. We have 3 now. Only 3. Where is Courage? Courage, you supported Victor before. Where is your hand? Okay. Okay, put your hands down. Who agrees with Precious that Oh, okay. Who agrees with Precious that finance is more important? Oh, Courage has changed her mind. Okay. Andrea
No, I
agrees.
haven't. It's the network.
Oh, it's the network. Okay, okay. All right. All right. So Courage is still accounting. Okay. 4 of 6 finance is okay. Okay. All right. You cannot put your hands down now. So the finance people wins it. The short answer is you're all correct. It's a chicken and egg situation. Which one comes first? Because the chicken comes first, finance is the chicken. Accounting only comes in when you've raised money and you spent it. So not so much which one is more important. Because I'm speaking to a team of entrepreneurs, venture idealists, people who have ideas, you want to focus on the finance part because that's your chicken. The egg is the accounting part. It's like somebody, you can, if you have $1 billion in the bank, then your accountant can be like, oh, Mr. Giwa, you spend so much, you know. But if you don't have $1 billion, there's nothing that the accountant will do. So while both are important, and you're right, guys, that we need to gather the data, but this subject of gathering data only starts after you've made a decision about raising money successfully and spending it successfully. Does that make sense? So yes, we are all correct. All ideas are okay, but bear in mind that you guys need to focus on the decision making, and then the numbers will sort itself out. Tosin, your hands is still up. Do you have a question?
No, I do not have a question, sir. I raised hand for the food.
Okay, all right. You can put it down now. Thank you. Good. So now that we understand that, what we're going to do is we are going to go through this to solidify this concept of finance more by looking at 3 examples so that you get it very clear in your head how it really works. And then we'll go into more details in the next session, okay? So I'll run through 3 examples of financing and how finance affects everybody, both government, companies, and individuals. So I'll use examples to demonstrate the concept of finance and the fundamentals of it. And then next session, we'll go into the accounting books and all of that and how to generate your own model, scenario planning, and all of that, okay? So the first example here, we look at government, public finance as is known, or government finance. So we see how that works. So notice that on this chart, there are 2 sides to it. You have raising and spending. As I've explained earlier, that's what finance is about. Decisions that you made regarding where are we going to raise money from, what are we going to spend the money on. And you're very clear on those 2 for the lifetime of your business. You want to say, this is how we're going to raise money, this is what we're going to spend it on. That's the decision that you need to make as a business owner. And you need to keep checking and going back to that decision, reviewing that decision, and analyzing whether it is working or not. And that's what essentially what financial management is all about. And that's what your model is all about. Your model, your financial model is a model that says, this is how much we need, this is where we're going to get it from, this is what we're going to spend it on. That's simply what financial model is all about. So let's start with an example now. Let's start with government. Government typically raise funds through 2 means. Okay, on the left, you can see that government raise funds through taxes. So for countries like the UK, where I live, the government raise funds through pay-as-you-go tax. So most of us know that. And when you go to work for a company, before you get your money, the government takes out the income tax. So if you are within the 20% bracket and you're on £2,000 a month, before you collect your 2,000, the government takes £400 and you have 1,006. Secondly, the government charges you road tax. So for your car, you pay a certain amount every year. If you in the UK, we also have what's called council tax. So the council charges you £250 a month. Then if you run a business like myself, you pay corporation tax on your profits. I think it's about 19%, going to 25% next year. So that's how the government raise funds. But sometimes they put all of that together and the money is still not enough to meet the needs of the society. For example, during COVID, the UK shut down, like most of the world, and the government needed to pay people because people were sitting at home and they need to still feed themselves. So the government had to go and raise funds from other sources. So one of them is loans. So QE or quantitative easing, as the word they like to use for it in economics and finance, essentially the government printing more money, essentially loaning itself. Sometimes the government goes out and raises funds from other countries. So they might go to China or the US or or loan money from private individuals. So in the UK, it's called bonds. The government will say, I will guarantee you 5% return every year for 20 years if you give us £10,000. In other countries like Nigeria, it's called treasury bills, where you go and buy treasury bills. The government will take money from you and give you interest. Or you can go to other international governments, go to other international organizations like the World Bank. So that's how they raise funds. You hope that on the other hand, they are spending the money on schools. This is not a political class, so we're not going to have this conversation today, but typically that's how public finance works, okay? So they collect all this money on the left, and then they spend it on schools, police, roads, health, defense. They pay interest on the loans they've taken, and some other things, foreign aid. It was a big deal in the UK recently when some politicians were complaining that the UK should not keep honoring its commitments to sponsor or support other organizations outside of the UK. So that's how it works. You see, raise funds, spend it. Let's look at corporate funding. Before we go, let me just show you an example of the UK. So this is like the spending of 2016 to 2017. So this is how much the government raised, and this is what they spent it on. Okay, social protection, 40 billion, health, education, defense. The government is paying interest on its loans up to 39 billion. Public order, social services, transport. So this is how you have to think as a business person as well. I'm raising money through this means and I'm spending it. So let's look at other examples now. So that's for public funding or finance. Let's look at corporate financing. So how do businesses raise money? Well, there are two ways by which the business raises money. First, it raises money internally through its own activities. So what is called retained profits. So if a business, profit-oriented business, for profit, spend, let's keep it simple, they spend $10 million and generate sales of $40 million. So when you take the 10 million from the 40, they have revenue of $30 million, okay? From that revenue of $30 million, they might pay out as dividend to their investors and interest to banks, 15 million. They might do other things, and they are left with $10 million. So those $10 million, that $10 million that is retained profit from the 30 that they made, comes back into the purse for spending the following year. Sometimes owners like myself, when the company runs out of cash, you might have to go into my private savings and put some money in the bank, some money in the business. Before COVID, we were struggling, and then COVID hit, and you just have to make payroll. You still have to pay your staff. So businesses might have to dig into their owner's fund to keep the business going. So that's all internal source of finance. Okay. Another source of finance is external, which is debt. So companies go out there, they go to banks. All the big companies do it. The Shell of this world, the Microsoft, well, maybe not so much the tech companies, but most companies go out there and raise money from the banks. Bank loans, they pay them interest and they pay the money back after some time. Some businesses go to government, especially during COVID, for example. Here in the UK, a lot of us businesses have to apply. The government was very generous to sustain some of us with some funds because they know what we're going through. So yeah, you can go to governments and the government will give you support, sometimes loans, sometimes direct grants, which was what happened during COVID for businesses in the UK. For small businesses like us, we got direct government grants to keep going. Sometimes you go to investors, like we've learned today. You could go to equity investors. You could go to debt investors and just go externally. And then what do you do with all that money that you raise as a business or from your retained profits, from the government? Well, you do the following things. You can spend the money on one or two things. This is very important, okay? As a business, you spend your money, all the money that you make or you raised, all the money that you've raised. So you have to think about it that way. The money you make is revenue, sales, but that's not the money you raise to run the business. Out of the sales numbers, you pay your interests, you spend money, all the money that's coming. So that money then goes into here, two things. All the financing activities on the spending side is one of two. The first one is you use the fund to acquire assets. So by that, we mean new machinery, like Tosin was saying earlier, that it needs funding to acquire assets, maybe some equipment to carry out some analysis, whatever it is Tosin was trying and his team was trying to do. So that's what you do with the money. So you acquire assets, equipment, buildings, raw materials. If you are a tech company, you buy line of code, you hire people to write your code for you, which is an asset, intellectual asset for the company, with some expertise. And then the second thing you do with the money is liabilities. So assets are things that in an accounting parlance, remember what I said about finance and accounting being different. From an accounting point of view, you want to always separate what is asset, what is liability. So asset is anything you spend money on that you can get the money back in some form or the other. So let's say you buy a house, you can sell the house and get some money back. Just something that you can say this thing has value. I've spent money on this and it is valuable. It's something that, for example, if you write code, if you get someone to write a line of code for you, well, that line of code is an asset because you can sell the technology to someone else. So that's how you kind of think about it a little bit. But then liabilities are things that you spend money on, but it's not something you can go back to and say, hey, we can do something with this. No. So for example, your salaries. Now, the expertise that your people bring in and that you accumulate as your corporate memory, now that's assets. But the actual salary you pay out every month, that's a liability. That's something that is due that you have to pay out anyway. And it's not like it brings something back to you, but you have to pay it out. So things that you hold, like your interest to your banks that you loan money from, your salaries to your staff, your bills, electricity, water bill, your taxes, those just go out to somebody else. You have to pay that. And those are your liabilities. Okay. Lastly, we'll go to personal finance, which is so this is corporate. And then, yep, we go to personal. Now, okay, we've got 1 minute more. Is that correct? Yeah, you see, I was going to time it perfectly, and then we'll finish and we stop here. So personal finance, very straightforward. How do you make money? Well, you make personal money by if you've got a job, or if you live in a country like that has social services support, maybe welfare payments from the government because you've lost your job or the money you've earned from your work is not enough to meet your bills. That's active. Well, for some, you make some passive income. Maybe you've got a property, you're renting out, you've got investment in businesses, they're paying you dividends, or maybe you sold your car or some other things, or other people's money. Like if you're a young person, like my daughter, she's got the bank of daddy, please, I need that, even though she's got a job now, but daddy still pays for a lot of things, or you can take a loan. But what do you do with all of that money? Well, you do a couple of things. Like a business, you could use the money to accumulate assets, things that you can convert to cash later. Your gold earrings, your gold necklaces, you could buy a property, you could buy shares in a company, all your other liabilities, money that just goes out and go away. They don't bring anything back to you. So like your bills, buy food, drinks, holiday, and all of that. So in summary, as you can see on this page, Governments, companies, and personal money is very similar. You raise it, you spend it. It is on that note that we end the session today. And the next time, next week, if I'm correct, we then go into the nitty-gritty of corporate finance. So that's when we talk about a balance sheet, cash flow, income statements. We'll explain them, understand what they mean, and then we'll look into how you can build your own that you present to your social investors. Thank you very much for joining today. I will hand back to Boson and Pro Ali team.
Thank you very much, sir. Please, can we just, with the reactions, can we just react to show some appreciation? Yes, thank you. Thank you very much, sir. Thank you so much. I'm sure we have questions, but I'm sure, because of our time, we'll take them next week, since we still have a follow-up session next week. So, but before we tell Mr. Gideon to go, please, do you guys have a few questions? Just like one or two. I don't want us to take lots of questions because of our time. Any question from anybody? Okay, sir. So if there are no questions, thank you once again, Dr. Gideon. Thank you so much. Let me check the chat.
Me, I like to elicit questions. I'm not going to let them go. Or else there are no questions. Okay. So what we are going to do now is really a test of knowledge, because it's always good to say no questions, or it's always convenient. So on the comment chat, please tell us the 4 types of financing you can have in a business. Let's see if that, I think that's even where we started from. So please put it there. 4 types of financing that you can explore in building your own venture. We are waiting. We have 8 more minutes. So 8 more minutes is a lifetime. We'll wait for it. So please, we're waiting, engage in the chat. 4 types of financing.
Where you can raise money for your business. What are your 4, name 4 or more places you could go to raise funds for your business? Financing options.
I have 2 questions also, and that's number 1.
Okay. Type away, guys.
Or have we forgotten? We're waiting. We need a lot of reactions, at least from the 15 people that are here. So we're waiting. The 4 types of financing method that you can use to raise funds for your business. Thank you, Tosin. It's only, okay, thank you, Precious. Thank you, Tosin. We're waiting on more in your own words, because you won't write it exactly as the other person wrote it. Yeah, this is what is called applicable knowledge. Yeah. So you see, for example, Tosin wrote bootstrapping, but Precious wrote bootstrapping and funds from friends and family, self-financing, bootstrapping. So please share your knowledge with us, what you have learned today, the 4 types. I'll wait for 2 more and then I'll move to my next question.
I'm sure you are typing away the network.
Nice, yeah. 2 more, please. Thank you, Bamio. 1 more. The full source is also the bootstrapping, actually. It's called friends,
it's okay
family,
to separate
fool.
it, yeah. We call them fools in finance. So you have the bootstrapping and the fools, family and friends. Some do. My students don't like it when I call it, but
yeah, 1 more person, please. If not, we'll not send invite link to next week, because that means we'll have to redo it again. Right. Thank you, Esther. Appreciate it. Other people's money. Thank you, Bamio. Thank you. A round of applause for everyone. My second question is, the investment criteria had three main theme, something like that. One of it is idea. Please share the other two. I lecture, so the lecturing has shaped my mind on how to ask questions.
I can see.
Yeah. And the investment criteria, one
That's
of
very
it.
good. Well done,
Right.
Precious.
Thank you, Precious. Really good.
Really good.
Other people, yeah. Two more and we'll go. I will take three for this one. Thank you very much, Precious. The business and future. Thank you, Ebenezer. Thank you, Tosin. Yes, so now learning has been made. I'd like to say thank you. We have 4 more minutes. We like to close right on time. Thank you, everyone, for this, for your participation and your active engagement. It's one thing to learn. I always tell people it's another. Oh, Andre, you had a question or a feedback or comments? Please go ahead. We can take it. Was it a mistake?
No, yes, I want to say thank you for the session. It was really good.
Oh, great. Yeah. Okay. Thank you. Thank you. We're seeing you next week. No better way to say we're looking forward to next week's session, same time. We share the invite as expected, and the AAPG team would also be back to join us in the session. And yeah, we're excited that you're here, and there's a lot of learning. I'm looking forward to building a financial model myself, because I know that it will be a place to ask all of the questions. So we have a feedback form in the chat. This feedback form, we don't leave without you filling it. So we'll not close the session until you fill, because we're also going to monitor in the background. We need to share that you really enjoyed Gideon's session, and we really need to also should demonstrate value to our sponsors. This itself is not fools, or I can't call them fools, but it's this was also funded by people, angel investors who want to see your business succeed. So we need this to demonstrate that the learning is good, the learning is valuable to you. So please fill the feedback session and we'll take a look at it on the back end and confirm to us. While you're doing that, I'd like to say thank you very much, Gideon. I appreciate it every time. This is as very fundamental as it can get, because I know that next week we're accelerating to a different level, and the knowledge of today will be very useful. If you'd like to catch up again to discuss your venture, Gideon has also thrown you a lifeline to say reach out. And again, if your business is not fundable, it doesn't mean that it cannot be fundable. It probably may need 1 or 2 tweaks, maybe to your model, maybe to your products, maybe to your service offerings, or maybe to your target audience. Yeah, maybe you're targeting wrongly. So we are also open to having this conversation, and we can make that happen if you do need that kind of support. So thank you so much, Gideon. I appreciate it, and we'll see you next week. And for everyone who joined, thank you. We're waiting for you to fill the feedback form before you go. Yeah. So and confirm how many we have, and then we'll take it from there. But Gideon, we can release you at this point while we keep them to fill the feedback form.
All right, thank you, Bosun. Look forward to seeing everyone same time next week. Enjoy the rest of your week and your weekend. I'll see you later.
By God's grace. Right. Okay. So please, Anne, back to you. Let's know who has filled and who hasn't filled.
Nobody has filled yet, so I'm trying.
The feedback link is on the charts. Please.
Let me post it again.
Yeah. Please click on it and fill it right away. We like that aim. You can keep it on the classes over. You can stop recording if it helps, but the aim is useful. So please, ladies, gentlemen, the feedback form, we're waiting. And if you are from the the Nexus community, there's going to be I can't say an assignment. I wanted to say an assignment, and I was thinking an homework. There's going to be an assignment on this. So stay tuned for that. Please fill the feedback form, everyone. Please fill the feedback form. We don't have any submission yet. And do we have any submission?
So I'm trying to refresh. The system is giving me some issues. Just a minute, it's almost. No. Let me see. Open.
We don't have any submission yet. Guys, we're waiting. So, okay, we have one submission. We're waiting for the others.
Yes, one person has submitted. And it's Tosin.
Thank you, Tosin. Please just type done once you're done. Type done on the chats once you're done. But we need to get that before we exit this class. Thank you, Courage. Andrea, Victor, Jane Carlos, Vignesh, Angela, Ebenezer, Precious. I'm calling names now because this is also the way we'll be looking for your names. Esther, Bridget, Bamio, Abdelrahman. Please fill this form. They say feedback is a gift. So if we are not paying for this, we can give feedback. Thank you. We have two now. Now 3. We're waiting. If you don't want this session to be scrapped by next year, please fill this because this is what the session will be evaluated by. Okay, we're waiting for all the dons. Courage is done, Bridget is done, Victor is done. Please put your done there when you're done.
Yeah, so 4 people has filled. 11 now.
11 people has filled now?
No, 5. Sorry.
5, okay.
Yeah.
Do you have any difficulty in filling the form? Let's know.